focus. This is the Million Dollar Upside community. And what our focus is for this community is to just be able to give back, one, but two, be able to kind of provide a resource for the people that, don't really know where to go. I mean, that was us when we started. We just said, look, I want to do multifamily. And we just jumped in. We had no idea what we were doing. We had no idea where to get the info from. Everybody that we talked to either said, bring me a deal or pay for my course. And so for us at the time, we just paid for the course. But a lot of people don't necessarily have that luxury of being able to pay for something like that, but they're hungry and they're motivated. So we wanted to be able to put out the content for people to at least start getting an idea of what they can be doing and where to go. And that's the whole reason that we're here today. Other than that, we're super excited to be a resource for people and to be able to do some deals with y'all. And that's ultimately the goal. So if you're looking for deals, bring the deals. If you're looking for people, bring the people, and we'd love to share what we know. Other than that, that's a short and sweet intro. Guys, we have an amazing guest for y'all today. Probably one of the most favorite topics that everybody are always talking about, right? Is raising capital. Everybody loves raising capital. So without further ado, we've got Kevin. Is it Chow? Cho? I got a
Ciao.
friend.
Ciao.
Okay. Kevin Chow. Welcome aboard, man. Super excited to have you. Go ahead and tell the people a little bit about yourselves and how you even got to be here today.
Yeah, hey, thanks, Joseph and Jada. I think a lot of people say they want to do capital raising, but I think a lot of people hate the idea of capital raising. And frankly, I think a lot of people just they're scared about asking people for money and they're scared about kind of the responsibility of doing that. And I think that's perfectly fine. You should. I think one of the things that people fail to think about when they're asking for money is that you're really a fiduciary. I mean, you have a fiduciary responsibility to people managing, and you should really care about it. You should have a little scare. If it comes easy and you're just grabbing money and all, just then you're not doing the job correctly. So I just kind of wanted to get that out there before kind of jumping into my story. So my background, I started off my career at JPMorgan. I was a private banker. I was advising high net worth individuals on investments and loans and everything else that you'll typically see, the services you'll see at a bank, but with a focus on working with a certain high net worth clientele. Now, I did that for a couple of years and really didn't enjoy the corporate life, and I think a lot of people don't enjoy the corporate life. So for the last decade, I've been more of an entrepreneur. I started several businesses. One of the businesses I built was it's in the high-end luxury e-commerce space, primarily focused on luxury goods like watches, handbags, jewelry. We had clients all around the world, primarily most in the US, but we would count billionaires, royal family members, YouTube stars, athletes as clients of ours.
Damn.
And built that business. It did really well until around the COVID time, and the luxury business did get hit a bit. And so the business slowed down due to supply chain issues and that type of thing that really brought brought prices up. And also even these clientele were not willing to pay some of the higher prices than luxury goods. If anyone is a watch collector, they probably know what happened to watch prices. That probably went up 50, 100% and all. And so um, that business I've been fortunate enough to turn that business and also another business of mine, which is more in the education tutoring space, um, into what I call passive income. So they've really become a side focus of mine. I have a team that works on the end and maybe a couple hours a week to check in to make sure everything's fine. The great thing about being an entrepreneur is that, and all of you guys that are in the real estate space, you are being entrepreneurs. I mean, you are really guiding and building your own pathway. But I've been doing it for a whole decade, and what I really like about it is that one, you're your own boss, but secondly, you're really kind of you're the guide to your own destiny. It's really how much work you put in is oftentimes correlated to the result at the end and all.
Oh yeah.
And moving forward, I look at real estate and capital raising really the same way. You're building a business, you're here for the long term. Um, so I had actually done some single family homes back in the 2000s. Just small stuff, some condos, single family homes. And I would say when I did it back then, I really didn't enjoy the experience. Um, Probably it was because I was bringing in the wrong tenants, and it seemed like every time I was bringing someone in, it just happened to hit the wrong mark and all. I was a little bit newer back then, but frankly, like I felt like there was more money going out, coming in a lot of these cases. I'm sure a lot of people have seen that, whether it's single family homes or if you're working on some of your own multi-family projects, especially smaller ones, and you're self-managing it, you've probably had to deal with your own share of bad tenants. Um, so this time around, I in around 2021, I decided I wanted to get into multifamily, and I wanted to really kind of learn. Actually, before I got into real estate, I really back into real estate. I took some time to kind of figure out where I wanted to go. You know, I had a lot of time now. My businesses were self-running, and I had time to figure out exactly what I wanted to do. Um, so first, I did some options trading, and during that time with GameStop and all those things, you either did really well or you probably didn't do so well. I happened to end up in the bucket that didn't do so well. So
Mm.
I found myself losing tens of thousands of dollars sometimes in a day just because I didn't know what I was doing. So that was not investing. So it was a mistake, especially as someone who came from an investment background, to be doing something like that. Investing should not cause you to feel like you're having a heart attack every day. And
Yeah.
and investing should be comfortable. So as I was looking at potential investment opportunities, I started to gravitate towards multifamily because, as everyone said, real estate is really a foundation for a lot of people building wealth, but also real estate is really a stable asset that you shouldn't be having a heart attack every day and all. Now,
Hmm.
is that the case? I don't know. So I also started myself in a mentorship for to kind of get acquainted. I found a mentorship as a good way to get some introduction into the space, but very quickly I learned that you will learn a lot of things along the path. Okay. What I learned very quickly is that in order to really succeed in this business, it is important to get good in some area. It is probably better to be good in a certain part, whether it's on the underwriting, the due diligence, the acquisitions, the capital raising, uh, or rather than being too, especially if you're new, being too scattered. Okay. The reason for that is that when you're building your initial deals and working with people, your partners really matter a lot. Okay. And you are more likely to partner up and people are more likely to work with you if you're bringing value to the deal. Okay. If you're good, so and mediocre in many different skills, that's not as valuable to a team than if you were really, really good at something. So
Hmm.
I always say take your time and figure out what is your secret sauce, your secret weapon. What is the something that you think you can add value to the team? So as I was doing these deals and all, and like many people, probably the easiest way to get into a syndication is really through the capital raising. And I like capital raising because um, it gives you the opportunity to shadow others and see how things are working
Hmm.
and also be able to see the inner works of the asset management and other parts of the deal. Now, one advantage I had was I had a great Rolodex. I had clients from my luxury business that have entrusted me, that have spent tens, hundreds of thousands with me. And I had that advantage. And that's why I decided to go down the capital raising route because I knew I had a skill and I'd also raised capital in the past for my own company. So I've actually raised money over 500,000 for my businesses. And I always like to say, if you can raise money for a startup, you can always raise money for real estate. So that's very, very much true. Now, I would say when I first started off, I started off with Class C and B deals, because that's what a lot of newer syndicators like to work with and all. And that is great. But one thing I did notice was that because of some of the inexperience of the sponsors, some of the deals did have cracks at all. Um, and value add deals are challenging because there are a lot of moving parts to it. The debt tends to be like a bridge loan, a floating rate. Maybe there's a rate cap on top of it, but you're paying for it. So the debt itself is usually a short-term maturity. There's a little bit more risk to it. But on the other hand, there's really the operation side as well. The rehab, being able to accurately project what the rehab budget is going to be, the timeline for it, as well as what it takes to deal with delinquent tenants and trading out the leases. It can be quite a handful, especially if it's like your first couple of deals at all. And noticing that, I quickly made an adjustment. So starting about, I would say in 2000, end of 2022, I started really shifting my focus to newer assets, Class A assets. I started shifting towards preferred equity investments because as a capital raiser, you are, again, as I mentioned earlier, a fiduciary. So you're really looking for opportunities that have that are quote unquote safe for your investors. Okay. Um, One thing I really want to emphasize is that when you're looking at an opportunity, you must focus less on the upside of the opportunity, but more on the downside. Okay. I think a lot of people look at the returns and just says, okay, this deal is a 18%, this is a 16%, 18 must be better. Okay. That is probably fine when the market was not as dangerous and difficult as it now. Today, it's really the other way around. What is the chance that I would lose my capital? Okay. So really, that is extremely important. I look for downside protection in my investments that I bring to my investors in terms of cash flow. So cash flow is really king in terms of the debt. But cash flow is king because really that's determines whether you might be foreclosed on by a lender, by preferred equity. Um, so I like investments where the cash flow is strong already out the gate. It's a lot lower risk because let's say it's cash flowing X, but we don't hit that number in the first couple months. Well, are you fi are you able to sustain 20% less cash flow? Okay. And what I've seen is that on certain deals, people have underwrote it with too little reserves, with too aggressive projections. And as a result, within a year, they're doing capital calls. Okay. So downside risk must be studied probably more intently, and especially the the what is going to happen in the first year or two when the cash flow can potentially be the worst. Okay. So I think that's extremely important. Getting onto as a newer syndicator, I really emphasize the importance of, again, partnering up with bigger operators that have a good track record because your reputation really relies on the performance of those operators. Okay. If those operators end up losing your investors' money, your reputation will go down the drain. And I always say, like, it takes 5, 10 deals to build up your reputation. It takes one single one to bring it all down. So be extremely patient on figuring out who you partner up with and all, and be patient in looking through every deal and truly spending the time to underwrite it. Another thing I would like to talk about is there's a lot of syndicators coming out and asking people to raise money, and they might give large GP shares for it. I've been approached on deals that are giving up to 50% of the general partnership to raise for a deal. Okay. The amount that you make or the amount of general partnership that you receive in a deal should be secondary to the quality of the deal itself. Okay. In some cases, there's a reason why they're offering you that much. The risk itself may be a little bit more risky. The deal itself may be a little bit more risky. The operators may be a little bit less experienced. But again, you run a risk that the deal falls apart and your reputation goes down the drain. So I think it's extremely important, especially the first couple of years, year or so, to really vet the deal before you go in, and all. And so as I have grown, every deal and every partner I work with, I try to work with a larger partner each time. So nowadays, I exclusively, most of my partners have 2, 3, 4 decades of real estate experience. They have billions of dollars under management. And this is extremely important because now I feel comfortable that they're going to be taking care of the operations, that the assets are in the right hands. And in return, they have someone they can rely on that can bring in the capital back their deals. So once you get to that stage, you start a cycle where you have good deal flow, and deal flow is very, very important. The more deals you have, the more deals you can underwrite from others that have already taken the time to underwrite, and then now you get to underwrite it again, and all. The better position you will be, and you can really pick the cream of the crop of the deals. And so with that, I've been able to scale my business by getting with bigger operators, raising more money. And one thing I do notice is that with larger operators, the assets tend to have not only are they underwritten better, but they usually have like certain like what I call perks. Maybe they have a nice long-term fixed rate loan, a HUD loan. Maybe there's a tax abatement on it. Maybe there's good depreciation, or maybe the structure has a better preferred return, better split, something like that. As you kind of get into these larger deals, they do actually tend to be structured a little bit more favorably because the deals tend to be larger, and therefore the fees don't have to be as aggressive. What that means is that as an investor, the investors do have more favorable numbers, or more favorable structure, which then makes the deal more attractive. So that's why I've gravitated towards working with larger operators, because the deal structures also tends to be superior to a lot of the smaller deals, where because the deals are smaller and because the numbers are smaller, you have to charge higher fees to compensate for it. As you start getting to the 50, $100 million deals, you may not need to charge 2% acquisition fees. You may not need to charge disposition fees or refi fees, because the deal itself is just larger and there's just more meat for everyone to have. And so that's one thing that I've noticed and all. And frankly, as I started moving up, what I used to have difficulty raising a few 100,000, now I'm raising multiple millions on deals. Because the deal itself is more attractive. They attract the larger investor, and as as you gravitate and build your business, you will soon build more relationships um, with institutional partners, family offices, at which point the check sizes become larger. Think of it as a business. You're starting small, you're building your reputation. Don't worry about how much you're making in the first couple of deals. Worry that you're building the right relationship with both your investors and your operators. You're taking the time to vet each deal thoroughly and all. And it's all right to be patient and all. You don't have to jump on the first deal that someone is doing or someone puts in front of you and all. Find the right one and the right one that fits it fits your investor base. One kind of I would say way that I judge a deal is to say, do I feel comfortable putting in money into this deal? And does it make me feel I wish I could put more to it? That's usually kind of like just a just a very subjective way when I'm analyzing a deal. It's like when I look at this, is this something that makes me feel warm and fuzzy inside? Okay, because if it doesn't, your investor is going to see that in you. You don't convey confidence to them, and it's just going to make it a little bit harder to raise money. So make sure that when you're raising that it's truly a deal that you like, a truly deal that you can get behind it. And it's always good to have a little bit of money in there because it shines through to your investor that you are really truly committed to this deal. Um, I think that's it for now. I kind of jumped around. I apologize. I kind of jumped around a little bit. But hopefully that kind of gives you a little bit back my story, how I got into capital raising, why I like the capital raising, and all. Um, so yeah.
Yeah, it was really good, man. Honestly, I was writing down a couple things as well. Like for anyone that doesn't know, I don't even think it was not even done like in a way you were dropping nuggets left and right. So there was lots of things to be picked up on what you were saying, especially for those that are newer into this space, right? Like just on the last thing you said, right? Conveying confidence is critical when you're trying to raise capital. Like if you're trying to raise capital and you're not confident about the deal, you're not going to raise any money. No one's going to ever invest with you. So doing all of that upfront work, which is what you were talking about, doing your due diligence,
Mhm.
whether that's through the deal or the actual operators or just your own due diligence in general, right? Having all of that upfront and done is going to give you that confidence, which is what you were talking about. And then even to add another step further is putting your own skin in the game, right? Investing your own money into the deal. Having those pieces put together, you don't even need to worry about it anymore because you're going to know, like, hey, this is a deal. Like, I put my own money in this. Like, I wouldn't be bringing you a deal, Mr. Investor, if I wasn't confident in it myself. And that alone is a critical point to raising capital, right? If you're not even going to be putting your own money or you're not confident about the deal, like you said, no one's going to invest with you. So that was
Yes, yes,
just the
absolutely.
last thing you said.
Yeah, I'll just kind of add very quickly. So I think when it comes down to raising capital, it's 50% the deal, okay, which are like the operators behind it, the deal metrics, those types of things, but it's 50% you. A lot of investors invest in me it's because it's me. They know me, they trust me, and when you build that trust, that's extremely important because they will invest with you multiple times. I would say about 50% of the capital that I raise now is of a lot less work because it's usually a repeat investor, someone that's already invested with me, or it's a referral. It's someone who may be investing in the current deal who wants to tell their buddy about it at all. And they're like, okay, and that's always great. So that's another thing I forgot to talk about is that capital raising is a scalable business. It's can be difficult at the very beginning. Okay, but as you start bringing in more investors and building your network, hopefully that next raise just become a step easier. Okay. I like to really get on a great opportunity because a great opportunity, a great deal really helps build your investor base because now your investors know, hey, Kevin, uh, you're bringing me things that no one else is bringing you. I trust you, and you want to be able to show them something that's unique and something that's truly special. So that's why, again, like the vetting process, taking your time to get something exceptional will pay dividends at all.
Man, it's powerful, dude. It's powerful. And I wanna touch on another point that you were making because you said it for anybody that wasn't listening. You said this at least 10, 15 times throughout your intro, right? You were talking about your reputation. It's 100, and it goes back to what you were just saying, right? 50% the person. That's another way of just saying your reputation, one as a person, but also as an operator too. So that is 100% critical. And I like the way that you were going about it, right? Like it's not about how much you can get paid on your first deal. It's not about how sexy the first deal is. It's really about just building up that credibility piece, creating your reputation as a multifamily investor. And
Mhm.
you hammered that point home. So for anybody that wasn't listening or was kind of listening, if you only got that one piece, like that is a critical factor in raising capital and it's so important. Um, you also mentioned in the beginning, you were talking about when people are new, and I know we did this as well, but when people are new, it's kind of like that shiny object syndrome, right? They're just like, I want to do all of it all at once at the same time, like right now. And you talked about what you said was people are scattered when they're new. And so if they could bring that scattered, like trying to have their hand in all the pots, instead of doing that and just focusing on one thing, that they can truly bring that value to somebody else who already has the experience in all the other ones. That alone, just creating that skill, because that's a skill, right? That's what you're doing. You're creating a skill in that one specific investor avatar, and you're bringing that component to somebody else that maybe doesn't have it, or maybe they're just not as strong in that area where you can completely focus on it and kind of alleviate that responsibility for that other investor. So another really, really good key point right there that I wish someone would have told us in the beginning because we were just like, I'm gonna do everything. Like we're gonna bring it home, man. We're gonna be like the best operators out there. But we're trying to do all of it all at the exact same time. And it was very difficult to stay focused and be able to maximize in those components.
Mhm.
You also talked, this was a good one too. You talked about focusing more on the downside of the property. Like, why shouldn't we do this deal? Like, what's wrong with this deal? Like, I need to find that first before I find the things that I like. Because every deal is going to have something that you like about it, right? Whether there's like a huge potential for upside, but maybe, like you said, they're being very aggressive with the underwriting or they're aggressive on expectations that that's not a realistic upside. Like you can say, oh, we're going to make $3 million on this deal, but if those numbers are completely skewed, there's, that's not even a possibility. So
Mhm.
actually figuring out that what you call the downside, that what's wrong with the deal is going to
Mhm.
save you and your reputation, right? Bringing it back to that. So I think that was a really, really, really good point. Um,
Absolutely, absolutely. Just yeah, and that's one thing I always tell my investors and that they appreciate. That's one thing I wish more capital raisers would tell the investors is that, hey, we care about capital preservation, okay? Here's the thing, if you're putting 50,000 in, your 50,000 goes to zero. It takes a lot longer to recoup that. The difference between if I get back 80,000 on that 50,000 or 90,000, that's not a big deal. Okay. I'll be happy to get 80,000 at 50,000 or 90,000. What I don't want happen is my 50,000 going to zero because the lender foreclosed, the cash flow, we had issues with cash flow and stuff like that. So that's what we try to look at. What is the worst case scenario? What can potentially happen? How how are the loan docs drafted and all? How is the preferred equity drafted? What's so I think a lot of I think as a capital raiser, you should learn to take the time to also read through legal documents.
Mm.
That's something that is extremely important, is being not like to a level of a lawyer, you don't have to, but be able to kind of know where you're going to jump into a legal document, see, hey, was it written right and all, and what kind of protections they have. What I've seen, even in very large operators and all, I have been able to pick out mistakes that were drafted in there because a lot of lawyers, they do recycle a lot of templates and they forget to change things up. So I think what is oftentimes worth it is to go through some of the main legal documents involved in an investment.
Man, are you saying that's your favorite part of the
That is
job?
definitely
Right?
not
That's
my
your favorite
favorite
part?
part, but it's usually the most frustrating, but it is an essential
Absolutely.
part. I
Mm.
would say I learned that because I have investors that are lawyers and all, and they would ask these type of questions. Now, they would be 5% investors, but over time, you realize just how important it is to be able to go through legal documents and pick out things and see if it's drafted correctly and favorably.
Yeah, and it happens all the time. Even if it's not a recycled doc, I've had an instance where we caught something on our attorney docs that were drafted, just brand new for the deal, and we still found things that either were worded funny or we didn't quite agree with how it was worded or whatever it was, right? There was definitely some stuff that we've caught before by doing exactly that, and it definitely was not the most glorious job. I don't even think attorneys like reading over this stuff. It's kind of boring. It really is. But like you're talking about, it's so critical to at least understand how to read it and what you should be looking for. So I would agree with that 100%. Um, the only other thing that I wrote down that I want to talk about was you said the bigger deals have perks. I like that you said that because people think, at least this has been like a commonality that I've and people I've spoken with. It's more on the newer investor side, but people think that once you start getting into these bigger units, like, oh man, I can charge so much more. I can do this, like you were saying, Ray. I'm instead of a 2%, I'm going to charge a 3%. But you actually said it the other way around, right? As in these bigger deals, I can bring these percentages down because it's still I'm going to make more money, but at the same time, now it's more enticing to my investors because they're not getting charged as much on the back end with all these fees. So I thought that was a
Yes.
really, really cool point that you added that in there because I agree with you. I really do. I think it's not about the money. Even on the later deals, because you mentioned in the upfront deals, it's not about the money, it's about building a reputation. But I think it also for all of the deals moving forward, it's again, you have a fiduciary duty to your investors to make sure that they're taken care of. So I think in all the deals, you should really keep that mindset. And I think that was such a good point that you said that because it just hammers
Mhm.
that one perspective home. Before we move on from the intro that you had, I saw Kat had a question, so I'll make sure that we get that answered. But Jada, did you have anything that you wanted to extract or talk about from what has been said so far?
Yeah, really, I just have there was so much that thank God Joseph was taking notes because I was just trying to digest everything and it was very educational. One thing that I've seen people have questions about in regards to staying in more of the class A is do you at least like when the market's kind of going to a recession or not as hot and we see a lot of areas that don't really turn into I guess it there are more homeowners than home renters. How do you kind of compete with that? Like, do you ever have any kind of worry that, oh, this is a class A product, so we're not going to be having as many people as the market kind of slows down and more people, do you see more people going to class B or class C properties? Renters, I mean.
Well, I think there's a cycle at all. Back in I would say the 2017 all the way to probably 2021 maybe before the interest rates went up,
Mhm.
Class Bs and Cs made a lot of sense because the interest rates were low. So the bridge loans had lower rates and everything was a lot lower risk because of that. Now with interest rates much higher, I mean, people are taking on 9, 10%. Good thing it's kind of come down a bit, but you're still seeing quite a bit. So all of that is a level of risk and all. The reason I like Class A's right now, even as the interest rates stay elevated and as home buying stays depressed, people that would have gone on market to buy homes realize that mortgages are now a little bit too expensive or homes just don't make sense. And for them, the good the type of asset that they will end up at are more likely going to be a Class A asset.
Mm.
So right now, as the interest rates stay high, for me, it makes sense that the Class A assets are going to be in more high demand because of these people that would have been buying homes, but no longer is. But as I also mentioned, I mean, again, it's the risk level. Class A's oftentimes will have one like better debt, because they're usually assuming some kind of loan that may have been in place a couple years ago when it was low. So many of my Class A's were recent construction 2020, 2021 built back when the interest rates were relatively low. And so we're able to assume those loans. Or other things that we can get are tax abatements. So tax abatements are at least the last 3 deals I did were all of my deals that are all have some level of tax abatement, 50, 75, or 100% tax abatement, which is really nice. It's an incentive for developers to build their properties in certain location. And so they've been handing them out quite a bit. So getting that tax abatement is really nice because now you've got properties that have a much higher profit margin as well. So we just closed an asset in San Antonio where it was running high 60 to 70% profit margin. So as you probably know, most multifamily runs maybe 55 or 60%, but with a tax abatement, you can kind of push that another 10 to 15%. So that again lowers risk on an asset when you're cash flowing much higher and have a higher profit margin.
And for those that aren't in the banking world and might not know fully what a tax abatement is, how would you explain it?
Yeah, so a tax abatement, so typically what happens on these properties, these newer it's a developer incentive. So the developer goes out there and let's say the city wants to build a property or wants the developer to build in a certain location, they'll actually create a tax abatement program. I won't go into very specific, but what happens is that uh, the agreement is a certain portion of the units, usually 50% of the units, have to be reserved for those that make a certain income level. Okay. And then in return, you don't have to pay property taxes. And especially in Texas, where property taxes are very high and it's usually the highest single line item under expenses, getting rid of it can be substantial. So on our property, it was saving about $400 per unit per month. Okay, so it's like we're getting $400 extra in rent just right off the bat. Now, by design, they're supposed to reduce the rent because supposedly it's usually based on the income level in the area, the AMI, the area median income. So based on that, they set a threshold on what you can, in a way, rent to those affordable tenants. So the idea is you're going to charge lower rents and we're going to get you the tax abatement. Now, the great thing on a lot of these tax abatement deals is that you can actually push those rents quite high. In some cases, you can push them back to market if the developer was able to build it in an area where the income is high enough. So on our asset, we're able to do that so that we're able to charge full market and get the tax abatement. Now, I will say a lot of programs have started changing where they realize that developers are taking advantage of this loophole. So they're saying you got to reduce by at least a certain amount I think in Texas, they changed the program this summer saying you got to reduce by at least 60% of what you're saving on tax abatement. Okay. But there are a lot of other properties where they haven't really changed these, or they're grandfathered in, where you can get full market rent and get the tax abatement. And that's a huge loophole. You really can't get that on Class Bs. They're mostly going to be on Class A assets where you can get something really nice like that. And all. But even then, most tax abatements are hugely valuable because maybe you're not getting the whole thing, but maybe you're only depressing two, let's say $150 in rent, but you're getting $400 in upside on the tax abatement. So now you're netting 250 right out the bat. And these tax abatements are also in a lot of cases transferable. So now you have an attractive piece of that you can sell to the next buyer and all. And if they start getting rid of tax abatements, then it becomes even more valuable to future buyers. So that's why I like to look for these tax abatements on these properties because they're in very high demand and buyers will most likely pay a premium for them.
Mhm. And last question about that as well before we get to Kat's question. Just for clarification for the tax abatements, more for me. So you're saying that, they're kind of not limiting, but the based on the income, is that different from like Section 8, or are they talking about Section 8 tenants?
So it's different from Section 8. So the people that comes onto these the tenants that come in are not Section 8. They're not getting vouchers. They have to qualify by their own merit. Okay, so let's say 3 times rent as an example. They do have to qualify. Okay, but what we have to do is ensure that their income match a certain level and also or stays below a certain level. So they have to be below a certain level of income and all, but they still qualify on their own accord.
Got it. Thank you.
Mhm.
So good.
And Felix makes a good point. There's typically a lot of politics that go in behind all of this. It's not
Yes.
just a random decision, right? Somebody somewhere is pulling some strings to make something happen for a personal or public agenda, right? There's always something behind it, which is not just real estate. That's in a lot of things, but that's a whole nother topic. We won't go into that. Okay, so we're pretty much here towards the end. I want to make sure that you guys, the audience, are able to ask questions. So Kat, do you want to come on and ask your question? Or you want me to just read it out? There you go. I got you. I see you.
Thanks. I was looking for the button that helped. Yeah. Hi,
Gotcha.
guys. Nice to be here. Yeah, I just had a question on because I'm doing the my raising capital journey after deal sourcing also, but the question that I had was particularly about cultivating your investors and keeping them interested along the pipeline. What I'm facing right now is having a great initial call, like getting these people booked on Zooms and getting that, hey, what's your soft commitment, where you want to go? But then if you don't have a deal currently to present to them, keeping them in the pipeline, is there any tips or tricks you can offer on the raising capital side there that you've seen, aside from like the typical, like put them in a automated email drip campaign? I kind of wanted to pick your brain a little bit on that.
Yeah, so you're talking about someone like if you're between deals and you just want to kind of keep them warm
Yep.
during that period. I mean, I think everyone has a different way. The key thing is to be extremely organized. So know like when was the last time you talked with someone? When's the last? I I think it's a little bit different with me because I do have a lot of deal flow. I'm usually doing like at least a deal a quarter and all. Um, and if I'm engaging someone, I like to talk about either a previously closed opportunity. So if I'm re-engaging someone, even be between deals, I may reach out to someone and just say, hey, just wanted to update you on our recent closing. Would love to spend the time to talk to you about why we did that. So I may not have a deal at that moment, but I will use a prior deal that I've worked on as a way to initiate conversation. Okay, so you don't always have to have a deal to be talking with someone. You can always be talking about a previous deal. And I always like to say, or in some cases, when I'm engaging newer investors, I like to have them send me some of the deals that they have received. Okay. And give them an opportunity to talk over that particular deal together. So now you actually get a little bit of deal flow with someone else. I mean, in most cases, those won't be deals of interest, but now you get a chance that you can sit down with an investor and kind of say, okay, let's underwrite this deal together. Let's talk about this, why you like it, why you don't like it, and all. And then you can also use that opportunity to kind of highlight, hey, okay, great, this is a great opportunity that you put in front of me. I want to compare with what we did last time. Okay, so you've got this with this. This is kind of deals that you're seeing. This is what we're doing. So again, you're utilizing, you're engaging them in many different ways. So you can get very creative engaging them. But one of the things I do a lot is I tell people, hey, you've got a deal. If someone's approached something, and all, show me what you have. Maybe I'll invest in it. I don't know at all. But it's a way to kind of have an education session, say, okay, because I think a lot of investors, if they're new, they may receive a deal, don't really know what they're looking at. Okay, is this standard? So that's one thing a lot of people ask me. It's like, is this fee standard? Is this normal? And all. Well, a good opportunity to kind of exhibit your understanding is to have them, if you don't have a deal, have them show you a deal. Yes. I think just another
I love
thing.
that. Thank you.
Yeah, another thing to kind of add about it is that I think a big part of capital raising is, as Felix mentioned, education. Okay, I spend a lot of time teaching them, and especially if you start when you start doing like more complex deals, and that's because a lot of people have seen like kind of the generic like syndication model. But as you kind of get into larger deals like I do, there's like these tax abatements, there's depreciation, there's a lot of things. And that's even a great opportunity to educate even experienced investors who may not understand, okay, oh, well, I didn't know that you can structure Class A's to have some sort of return. So a lot of investors didn't know, hey, you can get 16, 18% returns on Class A's. Their question is, how do you do that? Well, I say, well, this deal is structured. We have a 10% preferred return on it. So that right there will give you a little boost and all. We're charging lower fees on it. So that's another reason why you get boost. Our cash flow is a lot stronger out the gate. I love Class A's in the sense that if there's potential to push rent without having to invest money, that's great. That's low risk. And all, because if I know this asset has the ability to push $200 or $300 in rent and all because it's well below market, then and I don't have to put 5,000, 10,000 per unit to do that. I mean, that's a lot lower risk for me.
Yeah, so that's the I guess that's the tricky part. That's the egg before, the chicken before the egg. It's like, okay, you set up your materials and put your investors through the pipeline of like, okay, I'm gonna start educating you guys on all these things. Like there's that investor, that's the new one, and then there's the accredited investor that knows a little bit more, but so it's kind of like you have two, at least in my situation right now, have two buckets going where they're savvy, they know there's the savvy investor, but they haven't pulled the plug on an investment of that type. And then there's the newbies that are like, okay, yeah, like let's just talk about this, like, changing the game of your lifestyle and not having to work for your money type thing. So that's kind of where my road is at. But I hear you on that. And that's a great tip too, just to have the investors be like, what are you looking at? Like most of these new investors are like, well, I'm going to try Airbnb, or I'm going to try opening a business, and me being the business owner, I'm like, no, don't do that. Like that's crazy. So having those conversations, I think conversations is definitely where you're leading me to. I was thinking like email pipeline and meetups and podcasts and that kind of thing too. But yeah, it's food for thought for sure. Have a lot more meaningful conversations around that. So thank you. I appreciate it.
Absolutely, absolutely.
Yeah, and what I'll say is a phone call is always going to be the most impactful. The more time,
Absolutely.
more FaceTime, like phone call, Zoom, in person, the more of those that you can do, even if you're not talking about a deal, even if you're not talking about investing, the more you can do that, the more that you'll be familiar to them and you're going to build that trust. That's just been my experience on that specifically. 'Cause I had someone the other day ask me like, well, can I just like set up automation so I don't have to do any of that? Like you can, but now your hit ratio essentially, like let's say you have 100 people and you're getting, I don't know, 25% of those people that are actually converting on phone calls. Well, if you're doing it on text now, instead of 25%, maybe you're at like 5% or even lower. It's just a lot less traction that you're going to get if you automate it completely.
Absolutely, absolutely. I mean, today alone, I have 8 calls. So I'm always on calls, and they don't have to be investors. That's another thing I want to say. I'd like to talk to anyone, regardless if they're new or they're experienced, an operator, whether they will invest or not invest, get to know everyone and all. The more you have, as I mentioned, I get a lot of investors who are referrals. And there are people that said, hey, I don't invest and all, but maybe I've got a buddy that says he's looking to put in some investments. So what did they say? Like, don't judge a book by its cover. So it's really the same way. Everyone could potentially be an investor. It may not be their money. It could be someone else. And those are just as valuable. So I'm always building relationships, always on calls with people, and treat everyone really as an opportunity to get to know them.
Yeah, I definitely can attest to that. When we first spoke, it was very educational, and yeah, it's interesting. I feel like the people that don't have as much experience that I end up connecting with, um, they, I don't know, they're not as open as more seasoned investors, and especially yourself as well. You were giving all this education, you were asking me about stuff about myself, and I've noticed that a lot of people newer in the game start telling me about themselves, and without me even without me even asking, or even asking about myself. So yeah, interesting.
Well, we've got about 2 minutes here. If anyone has a quick question, we can address it. If not, then we can just adjourn for the evening. I want to be respectful of everybody's time. I'm gonna give it like 2 seconds. I don't see any hands up.
Yeah,
Yeah.
I will if I'll just throw in my contact information on LinkedIn and my email, and anyone certainly feel free to reach out. I'll throw even a calendar link while I'm at it. Like if anyone has any questions, they want to meet with me, talk about capital raising, learn more, and have questions you don't want to ask in the group, feel free to reach out and all. And so I think I think these are, I just threw the links down. I do not have a Twitter. I don't really use Twitter and all, but I use LinkedIn a lot. So the easiest way is to connect with me up on LinkedIn, which I know someone already did from today's call. But feel free to always reach out, email. I love talking with people, and that's the business. I mean, capital raising is all about relationships and talking with people and being comfortable talking with people. And the more comfortable you are, the better you'll become.
Put that on a t-shirt right there.
Thank you so much for coming on, Kevin. There's always new things that I learn every time I just hear you speak. It's amazing.
Yeah, I was actually gonna say, like, I definitely had more questions, but we ran out of time. So maybe
We
there's
can
a
always
part
talk.
two
We
to
can
the
always talk
conversation.
another time.
Yes.
Exactly. So I think everyone will get a lot of value out of that. So we'll definitely have to coordinate that as well. Um, Other than that, man, I just wanted to say I appreciate you coming on. Lots of gems dropped today, and it's so funny that because we've had multiple capital raisers come on, but every single one has a different perspective, different way about going about things, and I absolutely love it because again, that's the space where we want to kind of stay focused in. So I love having these conversations. So is that I'm gonna repost your plugins there. If you guys want to connect with Kevin, there it is in the side chat. Go ahead and copy that, save it, bookmark it, whatever you got to do. Other than that, man, I really, really appreciate you, and looking forward to